So, today we're diving into the absolutely massive $570 billion software industry. And what's fascinating is that it's become this digital battleground. On one side, you have these corporate giants playing a high stakes game of chess, and on the other, you have these solo artisans building incredible things right from their keyboards. Let's get into it. First, you just have to appreciate the scale we're talking about. The global software market is projected to hit $570 billion. I mean, that's not just a number, right? That's bigger than the entire economy of some countries, all built on lines of code. This is the playing field. And it's not just big, it's growing at a crazy speed. We're talking a 13% compound annual growth rate. To put that in perspective, that absolutely dwarfs the projected growth of the entire global economy. This isn't just a market that's growing, it's a market that is exploding. Which brings us to our first big idea, really understanding this booming digital universe. The pace of everything is just getting faster and faster. And, when there's this much opportunity, this much money flying around, it naturally creates a feeding frenzy. When an industry expands this quickly, the biggest players get very, very hungry. They start looking around for smaller, innovative companies to just absorb. So let's talk about that consolidation game. This is the world of mergers and acquisitions where the entire competitive landscape is getting redrawn by these multi-billion-dollar deals. It's the classic big fish eats small fish scenario. And this is happening right now. I mean, just look at 2024. Synopsys bought Ansys for a mind-boggling $35 billion. You had IBM grabbing HashiCorp to boost their cloud game, and the private equity firm Thoma Bravo picking up Darktrace. The giants are out there with their checkbooks open, for sure. So who's actually doing all this buying? Well, it's not just the big tech companies you'd expect. While those strategic buyers make up a big chunk, the real story here is private equity. A massive 61% of these deals involve PE firms, either buying companies directly or through other companies they already own. And this is so important because PE ownership brings this laser focus on financial metrics, which really dictates how these companies get valued in the first place. Which all leads to this really fundamental question, right? When you're dealing with things you can't really touch, like software and subscription revenue, how in the world do you decide what a company is actually worth? All right, let's decode that price tag. Because valuing a software company is part art, part science, but there are some core non-negotiable metrics that every single buyer is looking at. And it almost always starts with this, the ARR multiple. It's a simple idea. You take the company's predictable recurring revenue for the year, their ARR, and you multiply it by a certain number. Now that multiplier can be anything from, say, 4x to over 15x. And figuring out what that number should be, well, that's where all the magic happens. Because here's the absolute key. Not all revenue is created equal. The whole mindset of growth at all costs is pretty much dead. Today, buyers want to see efficient, sustainable, profitable growth. They need to know that the money coming in is healthy. And one of the quickest ways they do a health check is with something called the Rule of 40. It's super simple. You just take your annual growth rate percentage and add it to your profit margin percentage. If that number is higher than 40, you're generally seen as a healthy, well-run company that knows how to balance growing fast with actually making money. And does this simple little rule actually matter? Oh yeah. The impact on what you're worth is huge. Companies that clear the Rule of 40 get a median valuation multiple of 6.2 times their revenue. And the ones that don't, they're stuck down at 3.8x. Passing that one little test directly translates into millions, sometimes billions of dollars in value. But there's another lever that's maybe even more powerful. It's called net revenue retention, or NRR. All this measures is whether you're keeping your customers and getting them to spend more money over time. And look at the effect on valuation. It is just staggering. If you're losing customers, that's an NRR below 90%, your multiple is a pathetic 1.2x. But if you can grow your existing accounts by over 20% a year, your multiple skyrockets to almost 12x. It's an incredible value driver because it proves your product isn't just nice to have, it's essential. Okay, so while that whole high finance game of M&A and valuation multiples is playing out in the boardrooms, a really powerful countermovement has been growing from the ground up. This is the artisan's response, the world of Micro-SaaS. The term was actually coined by an entrepreneur named Tyler Tringas, and a Micro-SaaS is exactly what it sounds like. It's a small-scale business, often run by just one person or a tiny team, and instead of trying to take over the world, it focuses on solving one very specific problem for a very specific niche audience, and just doing it better than anyone else. And when you put the two models side by side, the difference is it's night and day. Traditional SaaS is all about huge teams, big checks from venture capitalists, and trying to capture a massive market. Micro-SaaS is the total opposite. A handful of people funded out of their own pockets, bootstrapped, with a laser-like focus on a small niche they can completely own. And this isn't about being small by accident. It's a deliberate choice. It's trading that explosive, crazy growth for control, for sustainability, and for a real connection with your customers. You know, this quote from Paul Graham, the founder of Y Combinator, just nails the entire philosophy. It's better to have 100 people who love you than a million who just sort of like you. It's not about market share. It's about building a tribe, a loyal community, because you are the perfect solution to their problem. In a way, it's like a return to digital craftsmanship in an age of mass production. So as we look ahead, what we're really seeing in the software industry are these two very distinct paths emerging. It's almost like they're operating in two parallel universes. On one path, you've got the scale-up model. It's fueled by venture capital, it is absolutely obsessed with aggressive growth, and the end game is usually a massive acquisition. Then on the other path, you have the artisan model. It's bootstrapped, totally focused on a niche market, and built for long-term, sustainable profit. Both are completely valid ways to build a business, but they represent two fundamentally different philosophies. And that really leaves us with this one big, final question. As AI makes it easier and cheaper than ever to create incredibly powerful software, where is the next truly game-changing idea going to come from? Is it going to be born from the massive resources and data of a corporate boardroom, or from the focused passion of a single founder working away in a bedroom? The game is on.